Most people imagine a bank as a high-security warehouse. The logic is straightforward. You deposit physical cash, the bank locks it away, and then lends those exact same bills to someone else. Imagine 10 people deposit $100, creating a $1,000 pool. In the warehouse model, lending 100 drops deposits to 900, but actual banking just adds a new $100 entry for the borrower. Total deposits now sit at $1,100. The borrower now has a $100 to spend, while the original 10 depositors still have their full $1,000 available to them. The money supply grew by 10%, yet no physical currency moved and no printing press was used. The vault model fails because it treats banking as physical storage. In a modern economy, the act of lending creates a new deposit entry, adding to the total money supply through accounting alone. The borrower spends that money at a supplier, who redeposits it. The bank sees a new deposit to back more lending. With a 10% reserve requirement, it locks away $110, but can lend the remaining $990. This creates a diminishing loop of lending and redepositing 90% of every new amount. Because it only lends a fraction, the expansion hits a mathematical ceiling. That initial $1,000 can support $10,000 in total deposits. The town now has 10 times the money it started with, even though no new physical bills ever entered the system. Money functions here as a record of authorized credit. The supply expands and contracts based on ledger entries created when a bank approves a loan. This system works smoothly as long as the ledger money stays in motion, facilitating trade and paying for services across the entire town. Stability depends entirely on public confidence. If a rumor of insolvency spreads, that trust can vanish in a matter of hours. If 10 people show up at once demanding their $1,000 in physical cash, the bank faces a $1,000 demand that it must fulfill instantly. This reveals the top-heavy structure of 10-to-1 leverage. $10,000 of deposits are precariously supported by only $1,000 of physical reserves. The bank cannot pull the missing cash because that value is locked in long-term community loans. To find immediate cash, it must borrow from other banks, sell its loans at a loss, or simply lock its doors. The mechanism that creates wealth through leverage also creates a permanent structural vulnerability. The system only functions if most people never ask for their cash at the same time. This process is reversible. If the act of taking a loan creates money, then the act of repaying that loan destroys it. Watch the ledger as a borrower pays back $1,000. The loan entry and the deposit entry both fade away. The total money supply in the system shrinks by $1,000. When borrowing slows down across an entire economy, the money supply naturally contracts. This happens through accounting alone, without a single physical dollar being removed from circulation. This ledger system dictates the reality of your own checking account. Your monthly salary arrives as a digital transfer, feeling like a handoff of a fixed commodity. That salary is actually business revenue, supported by a vast, invisible network of credit lines and banking liquidity. A bank balance is a legal claim on value rather than a box of currency. The entire financial structure rests on the expectation that we won't all demand the system settle its promises at once.